Hi, this is Mike Larson for Money and Markets TV. In normal times, the stock market is really closely tied to the underlying economy. But this current market environment is anything but normal. Super low volume rallies in stocks, levitation in gold, a slump in the euro followed by a slump in the dollar. All these clues tell me that the asset economy is floating on a sea of liquidity. And the reason is continued money printing by central banks around the world. First, it was the long-term refinancing operation from the European Central Bank, and now we're hearing more dovish talk out of the US Federal Reserve. But while all that easy money is propping up the asset markets, the real economy is floundering. Consumer spending was unchanged in December, missing estimates. The Conference Board's reading of January consumer confidence dipped more than expected. Meanwhile, manufacturing in the Chicago area fell from a month earlier, also missing estimates. And things are even worse in the housing market. November's S&P Case-Shiller report showed home prices dropping by 3.7% year over year. December new home sales fell 2.2%, while pending sales of existing homes slid 3.5%. All of those numbers fell short of expectations. So are you starting to see a pattern? Now you may argue that the stock market has had its best start since 1997, but the economy is nowhere near as healthy as it was back then. It's clear that the rally is entirely due to quantitative easing or money printing from central banks around the world. And that just proves my point that QE does relatively little for the average person on the street. It doesn't help them find jobs, and it doesn't help promote real, healthy, sustainable economic growth. So what's my advice for this kind of market? What can you do to ride the wave without getting swept away? Well, I've pared back broad market hedges and focused on a few select asset classes and companies that can make the most of these QE-driven gains without completely collapsing once the free money party ends. And that's working out. So I suggest you follow the same game plan as long as central bank money printing is driving the bus rather than underlying economic fundamentals. And then, a few quarters or a few months down the road, when investors realize that QE is failing once again to spur real economic improvement, I'll flip right back to the strategy that performed so well last summer, namely the use of aggressive downside plays. I'm Mike Larson for Money and Markets TV. Thanks for watching.